So think back to January 2015.
Oh, yeah. The Swiss franc.
Exactly. I mean, the financial world witnessed something that just completely broke the brains of technical analysts everywhere.
Truly unprecedented.
Right. The Swiss franc, which is a major global currency, it surged nearly 30% against the euro in like a matter of minutes.
Which is just staggering.
Just think about that for a second.
Okay.
30%. I mean, in the currency markets, a 1% move is considered a massive, highly volatile day.
Oh, absolutely. People lose their minds over 1%.
Yeah, so 30% it's an earthquake that just swallows the entire city. And the crazy part is the order books look completely normal just moments before.
Totally fine. Business as usual.
Right, the charts look perfectly fine. And then, without any prior technical warning at all, the market simply broke.
It snapped.
So today's deep dive is really about the invisible plumbing that caused that break and, causes thousands of smaller breaks every single day.
Because you can't see it on a surface level.
Exactly. We are moving completely beyond price-centric thinking today. Because if you want to understand why markets actually move, or actually why they violently refuse to move, we have to look underneath the hood.
We have to look at the engine.
Right, the invisible engine of the market, which is capital flow. And specifically, we're getting into the hidden mechanism of capital absorption.
This is so crucial.
It is. Because if you've ever, bought a textbook breakout only to watch it instantly reverse and hit your stop loss, this is exactly what was happening to you. You weren't necessarily wrong about the chart.
No, the chart looked exactly how the textbooks say it should.
Right. But you were just acting as liquidity for a massive player's absorption campaign.
And honestly, realizing that is the single biggest paradigm shift a market participant can make.
It changes everything.
It really does. I mean, we're trained literally from day one to treat price as if it is the absolute truth, like it's the engine of the market.
Yeah, price is everything.
But the reality is that price is just the exhaust.
The exhaust. I like that.
Right. It is the byproduct of a much deeper, much more mechanical process. Once you stop obsessing over where the price currently is and, start focusing on how the market is actively processing incoming buying and selling pressure.
The actual mechanics of it.
Exactly. That's when the seemingly irrational chaos of the market begins to actually make structural sense.
Okay, let's unpack this from the very beginning because I really want to challenge this starting premise.
Sure. Go for it.
I mean, I think most of us are trained to use price as our primary and sometimes our only lens.
That's what's on the screen.
Right. We got trend lines on charts. We look at moving averages. We think entirely in terms of price momentum.
Which makes sense on the surface.
Yeah, like we look at a currency pair and we track the pips, those tiny fractional price movements that dictate whether we make or lose money.
The profit and loss.
Exactly. And the basic logic is, well, if the price goes up, there is demand. If it goes down, there is supply.
Basic economics.
Right. But you're saying this entire starting point is fundamentally flawed.
It is completely flawed because it assumes price is the sole driver and the only indicator of intent.
Okay, so give me an example of when that breaks down.
Think about what happens when strong, really aggressive buying hits a market and the asset does not go up.
Right. The price just stalls.
Exactly. If your entire worldview is based on price, you are immediately confused in that scenario.
Because your indicators are screaming buy.
Right. Your momentum tools are flashing green, the volume on the tape is just surging, but the reality is a flat line on the chart.
And that's where absorption comes in.
That is capital absorption. It is the answer to that exact confusion. It's the market's ability to take in sustained aggressive buying or selling pressure without a proportional move in price.
Okay, I need to understand the physical mechanics of that.
Let's do it.
Because, if I go to a local farmer's market, right, and I want to buy 100 apples.
Okay. 100 apples.
But there are only 50 apples on the table. The vendor's going to raise the price of those apples immediately.
Of course. Supply and demand.
Exactly. That is basic supply and demand. So if huge volume is hitting the financial tape, if thousands of orders are flooding in to buy a stock or a currency, why doesn't the price immediately adjust upward, just like the apples? What is structurally different there?
The difference is really about active intent versus passive existence.
Active versus passive.
Right. In your apple scenario, the supply is completely static. There are only 50 apples. They physically exist right there, and that's it.
Right. He can't magically conjure more apples.
Exactly. But in financial markets, supply can be highly dynamic and highly aggressive.
Okay, how so?
If aggressive buyers enter the market and they're buying huge size and the price stays completely flat, it means someone on the other side is actively absorbing that demand.
They're providing new apples.
Yes, they are intentionally stepping in front of that moving train, providing an unlimited supply of apples at that exact price.
It's not a shortage at all.
No. It is a fundamental process of inventory transfer. Ownership of that asset is quietly, steadily changing hands. It's going from the aggressive buyers to a massive, patient seller.
I want to make sure I'm visualizing this correctly for everyone listening too.
Visuals help a lot here.
Yeah, let's use an analogy. Think of it like, well, like a massive concrete dam holding back a river.
That's a great way to picture it.
Right. If you are just standing there looking at the surface of the water in the reservoir, it looks completely calm.
Serene, even.
Exactly. You can't see the millions of gallons of pressure building up against that concrete wall beneath the surface. You just see a flat, tranquil lake.
But the reality is very different.
Yeah, the dam is there, absorbing all of that kinetic force. If you just look at the surface, which is the price, you completely miss the reality of the pressure.
That captures the dynamic perfectly. The rushing river water, that's the aggressive capital flow.
And the physical dam is the absorption.
Exactly. And just like that physical dam, absorption is fundamentally about intent and capacity.
Intent and capacity.
Right. It is the willingness of massive market participants to take the other side of a trade, and often in staggering size.
Like billions of dollars.
Oh, easily. And here's the crucial part that really trips up retail traders.
What's that?
These massive players are often absorbing this flow for reasons that have absolutely nothing to do with short-term price movement.
They aren't trying to day trade.
Not at all. They aren't trying to scalp a few pips. They are executing massive structural mandates.
So they are just sitting there, taking the hits, building their massive position or offloading their risk, while the rest of the market is just staring at a flat price line.
Staring at the flat line and wondering why their moving averages are failing them.
Right. The indicators are totally useless in that moment.
They are quietly setting up the future move. But to understand how this dam actually works in practice, we have to look at the invisible plumbing of the market itself.
The stuff we can't see on the screen.
Exactly. We have to look at the microstructure.
Now here's where it gets interesting. Because we naturally assume that every time I hit the buy button on my brokerage app, there is just some other trader sitting in their living room hitting sell at the exact same millisecond.
Like a direct connection.
Right. We think of it as a direct peer-to-peer match. But that's not how institutional finance actually operates, is it? We really need to talk about the middlemen.
Yeah, the peer-to-peer idea is a total illusion. You have to look at the role of dealers and market makers.
The big banks.
Right. These are the major institutional banks, the tier 1 liquidity providers. They sit at the absolute center of the global financial system.
They are the hub.
Exactly. They intermediate the flows. When a massive order hits the market, let's say, a major global pension fund needs to buy €1 billion.
Okay, €1 billion. Massive order.
The dealer doesn't just scramble to find €1 billion worth of individual sellers instantly.
They can't, right? That would take forever.
Right, so what do? They warehouse the risk.
Wait, I want to stop you right there and push back on that because that sounds insane to me.
It sounds counterintuitive, I know.
It really does. So these dealers are essentially taking on a massive short position just to accommodate a big buyer.
Yes.
They are selling €1 billion to that pension fund straight out of their own inventory.
That is exactly what they are doing.
Let's use a real-world equivalent because
Okay.
I need to wrap my head around the risk here. That sounds like a used car lot.
Okay, I like where this is going.
So if a massive rental car company suddenly dumps 500 used cars onto the local dealership's lot.
Just offloads all of them at once.
Right. The dealership buys them all, takes this massive hit to their own inventory, parks them in the back, and just hopes they can slowly sell them to regular families over the next 6 months without crashing the local car market.
That's a perfect analogy.
But in finance, isn't that incredibly risky for the dealer? If the market suddenly rips higher, that dealer is caught short €1 billion, and they take a catastrophic loss.
It is an excellent analogy, and it highlights the exact immense pressure that dealers face every day. But they manage that risk through a very specific set of mechanics.
Okay, how do they survive that?
We have to contrast two types of flow first. You have aggressive flow, and you have passive flow.
Aggressive and passive.
Right. Aggressive flow is that pension fund. They are using market orders. They are demanding immediate execution right now, regardless of the exact price, because they have a mandate to get that money deployed.
They just need it done. Give me the euros now.
Exactly. Passive flow, on the other hand, is made up of limit orders. These are participants waiting patiently to be filled at a specific price.
They're just resting on the order book.
Right. So absorption happens when the dealer, acting as a passive participant, consistently steps up to meet that aggressive flow. They warehouse it without letting the price move.
So the dealer acts as this shock absorber. They take the initial hit. They warehouse that billion-euro order. But their risk managers must be screaming at them, right? I mean, every desk has a value at risk limit, a VAR limit.
Oh, absolutely. They are heavily monitored.
They can't just hold a billion-euro short position forever. What is their actual execution strategy once they've absorbed that massive hit?
They have to bleed it out into the market, and they do it meticulously.
Bleed it out.
Yeah, they redistribute that risk over time. They might use algorithmic execution, like a time-weighted average price algorithm, a TWAP.
A TWAP. Okay.
This slices that massive billion-euro position into thousands of tiny, invisible pieces. And it slowly feeds them into the market, every few minutes over the course of days or even weeks.
So it doesn't spook anyone.
Exactly. Or they might slightly adjust their pricing. They skew their bid-ask spread to naturally attract more sellers to balance their books.
To incentivize the other side.
Right. This entire process of warehousing and redistributing risk, that is what creates a delayed price reaction.
So while the dealer is busy transferring this risk behind the scenes, using their dark pools and their TWAP algorithms, the price on the retail trader's screen stays flat.
Totally flat.
It looks like a dead, boring market.
But underneath, billions of dollars of risk are violently changing hands.
The dam is holding the water.
Exactly. And the price only actually moves once this redistribution process is completely finished. Or, and this is the explosive part, or if the dealer's capacity to warehouse that risk breaks down entirely.
If the river overflows the dam.
Yes. If the aggressive buying is so relentless that it breaches the dealer's value at risk limits, the dealer simply refuses to take the other side anymore.
They just step away.
They pull their offers, they step back entirely, and that is when the price gaps violently higher, searching for the next available seller, and that seller might be miles away on the order book.
Wow. It's wild to think about. We see a stable, flat price chart, and we naturally assume the market is quiet, maybe even safe.
A safe, calm day.
Right. But a stable price in the face of heavy underlying volume means the market is actually working at maximum capacity to hold things in place.
The engine is redlining.
The engine's redlining, but the car isn't moving. Which leads me to something that I think confuses almost everybody, myself included.
What's that?
We naturally assume that a market with lots of orders, a thick order book that you can see on your depth of market tool, we assume that is a safe, stable market.
And that is probably one of the most dangerous misconceptions in all of finance.
Really?
Absolutely. And it stems from confusing two completely different concepts: liquidity and absorption.
They aren't the same thing.
Not at all. They sound similar, and financial media uses them interchangeably all the time, but structurally they are opposites in how they behave under pressure.
Okay, break that down for me. Because if I pull up an order book and I see thousands of limit orders sitting at every price level above and below the current price,
Yeah,
isn't that liquidity?
it is.
And doesn't that guarantee that the price won't move easily? Because it has to chew through all those orders?
It is liquidity, yes. Liquidity is simply the availability of orders.
Okay.
It is how many limit orders are visible sitting in the order book on your screen.
Right.
But here's the catch. It is entirely passive.
Passive.
Right. It is a statement of intent under current conditions. Absorption, on the other hand, is the willingness of participants to actually keep those orders there and take the other side of aggressive flow when market conditions suddenly change.
So let me try another analogy here to see if I really grasp the difference.
I love the analogies. Let's hear it.
Okay. Liquidity is like having a giant sports stadium with 100,000 visible seats.
Huge stadium.
Right. But absorption is whether anyone is actually willing to stay sitting in those seats and watch the game when a massive thunderstorm suddenly rolls in and it starts pouring rain.
That is precisely the difference.
Really?
Yes. You can have a market that is highly liquid in normal conditions. The stadium is huge. There are resting limit orders everywhere on the screen.
The seats are full.
But if a massive, aggressive seller suddenly steps in and starts dumping market orders, the dynamic changes instantly.
The rain starts falling.
Exactly. Those resting limit orders, they are mostly run by algorithms.
Right.
And algorithms are programmed to cancel their orders the exact millisecond they detect toxic aggressive flow.
Because they don't want to get run over.
They don't want to catch a falling knife. So the algorithms cancel their orders, the liquidity vanishes in a microsecond, and that market, which looked so thick just a second ago, completely lacks absorption.
The stadium looked full, but everybody sprinted for the exits the exact second the first drop of rain hit.
The seats are completely empty.
And what happens to the price?
It crashes straight through that empty space. This is the exact mechanical anatomy of a flash crash.
Like the May 2010 one.
Yes. We saw this notoriously in the May 2010 flash crash in the U.S. equities market.
Right, where the Dow dropped, what, nearly 1,000 points in minutes?
Exactly. The order books looked incredibly thick 1 second. But when a massive sell algorithm started dumping E-mini S&P contracts, the high-frequency trading firms providing the liquidity detected the imbalance.
And they pulled out?
They pulled all their bids. The liquidity was there, but the absorption was zero.
Zero.
The price plummeted perfectly freely until new buyers finally stepped in way down the chain.
That is terrifying.
It is.
Because it means the depth of market tool on my screen is essentially lying to me.
Well, it's telling you a truth that is highly conditional.
Right, it's showing me a best-case scenario that won't actually exist when I really need it.
Yeah.
But what about the inverse?
The inverse.
Yeah. Can you have a market that looks incredibly thin, but is actually rock solid?
Absolutely. You can have a very thin market, a small stadium with very few visible orders on the screen.
So to a retail trader, it looks incredibly dangerous and volatile.
It looks terrifying. But if there is just one dominant, massive player, say a central bank defending a currency peg, who is willing to absorb absolutely every sell order that comes in, that thin market will be incredibly stable.
Because that one player is the dam.
Exactly.
It doesn't matter how few people are around or how thin the book looks. If that one player has deep pockets, an infinite mandate, and they refuse to move their bid, the price physically cannot go down.
Stability depends entirely on who is willing to absorb the flow, not just how many limit orders are flashing on a screen.
The who matters more than the how many.
Much more. High liquidity guarantees absolutely nothing if the participants providing it vanish when the pressure hits.
This is a total mental flip.
It changes how you see everything.
It really does. It means everything we see on the surface, the volume bars, the order book depth, the traditional indicators, it's all secondary to this invisible force. We are trying to measure the wind by looking at the leaves, instead of actually understanding the atmospheric pressure.
That's exactly what we're doing.
But if absorption is this invisible mechanism holding up the market, and if we can't see the dealer's dark pools or their VAR limits, how do we actually know it's happening?
You mean practically?
Yeah. How do we spot these footprints in the wild before the dam breaks?
Well, it is invisible in the sense that you cannot see the exact name of the participant or their account balance, sure. But it always leaves tracks.
Okay, what kind of tracks?
It leaves very distinct footprints in the price action and the order flow if you know what you are looking at. The clearest, most obvious sign on a standard chart is repeated tests of a specific level without a subsequent breakout.
Okay, picture the chart for me. Walk me through what that looks like in real time.
Imagine the price of a currency pair pushes up to a major psychological level, say 1.10 on the euro.
Okay, big round number.
It hits it hard. You see a surge in volume on the tape. And then it immediately rejects and moves lower.
Bounces right off.
Right. A few hours later, it tries again. It drives up, hits 1.10 hard, and rejects instantly. It tries a third time. It tries a fourth time. Traditional technical analysis often looks at that pattern and says, look at all this buying pressure pushing against resistance.
Right. The ceiling is weakening with every hit.
A breakout is imminent. Buy the breakout.
Yeah, literally every textbook says an ascending triangle pressing against resistance means the sellers are getting exhausted. So if I'm looking at a chart and the price just keeps hammering the ceiling over and over but won't break through, are you saying the traditional advice is completely backward?
You have to separate the environment.
What do you mean?
In a low absorption, highly imbalanced environment, yes, aggressive pressure can crack a thin ceiling.
Okay.
But when you see repeated heavy volume hits at exactly the same price that instantly reject, you are looking at a high absorption environment.
The dam is holding.
Repeatedly hitting a ceiling without breaking through doesn't mean the ceiling is getting weaker. It means someone with massive inventory is actively absorbing all of that buying pressure.
They're just soaking it up.
It is an equilibrium. It is not a magical technical resistance line drawn by a protractor. It is a real-time physical flow phenomenon.
There's an actual person or algorithm there.
Exactly. Someone with massive pockets is sitting exactly at 1.10 and saying, I will sell to every single buyer who wants to step up. Bring it on.
Wow. And until that massive seller completely runs out of inventory to sell, or, until their algorithmic execution program finishes its daily run and turns off, the price physically cannot go a single pip higher.
It cannot. It's impossible. And this creates what we call a compression environment.
Compression?
Right. When you have high absorption from massive players on both sides, markets compress. The trading ranges get incredibly tight. Volatility drops to near zero. Every single breakout attempt repeatedly fails.
It's an absolute meat grinder for retail traders.
It is torture for momentum traders.
Because their indicators are just lying to them.
Because their indicators keep crossing over, they keep buying the new high, expecting it to run, and the absorber just happily fills their market order and pushes the price right back down into the range.
Just farming them for liquidity?
Basically, yes. You can visually see this on candlestick charts in the form of wicks, or what order flow traders call failed extensions.
Explain the anatomy of a wick in this context. Because normally we just think of it as, well, the high or low of a given time period.
Right. But look at the speed of the rejection. That's the key.
The speed.
An aggressive move spikes up, taking out previous highs, triggering everyone's breakout alerts.
They're breaking out.
Exactly. But within seconds or minutes, the price is slammed violently right back down to where it started, leaving a very long wick on the top of the candle.
A huge rejection tail.
That wick is a direct visual representation of absorption. It proves that the opposing interest at that specific price was completely overwhelming. The aggressive buyers ran directly into a brick wall of limit orders.
The dam held. The water splashed up over the top for a second, but the concrete held firm.
Exactly right.
Now, I know some advanced traders use things like footprint charts or volume delta to see this even more clearly. Can we talk about that? Because that seems like looking directly into the matrix.
Oh, footprint charts are incredibly valuable for spotting absorption because they look inside the candlestick.
Inside it.
Right. A normal candlestick just shows you the open, high, low, and close. That's it. A footprint chart shows you the exact volume of market orders that traded at the bid versus the ask at every single price level inside that candle.
Okay, so if price pushes up to 1.10, instead of just seeing a line hit 1.10, what does the footprint chart actually show me?
It might show you that at the price of 1.0999, there were 50 contracts traded. But at exactly 1.100, there were 5,000 contracts bought at the ask.
Whoa, a massive surge of aggressive buying.
Massive.
The price should fly higher.
Exactly. But if you see those 5,000 contracts hit the ask and the next tick is immediately lower, back down to 1.0999, you have just witnessed pure absorption.
Because they didn't gain any ground.
None. Those 5,000 aggressive buyers got completely stuffed. Someone swallowed their entire order instantly and didn't give an inch of ground. When you see extreme volume anomalies at the extremes of a candle that result in zero continuation, you have found your absorber.
That makes so much sense.
Yeah.
It takes it from a guessing game about, arbitrary lines on a chart to observing actual physical inventory being traded.
Exactly. It's empirical.
What about outside of just the single price chart? Can you see absorption by looking at the broader macroeconomic picture?
You absolutely can, and you must. You look for cross-asset divergence.
Divergence.
Yes. The global macro landscape is deeply interconnected. Let's say bond yields are absolutely screaming that a massive directional move should be happening in the currency markets.
Like a major panic.
Right. Short-term equities are tanking, treasury yields are spiking vertically. The entire macro picture is flashing a massive risk-off sell everything signal.
Everyone is heading for the exit.
But you look at a major currency pair, say the Australian dollar against the US dollar, and it is just flatlining.
Just sitting there.
It is completely ignoring the global panic.
That's the divergence. The macro environment dictates it should be plummeting, but it isn't.
Right. And that tells you that structural absorption is temporarily offsetting the entire macroeconomic bias. Someone, somewhere, is stepping in and aggressively buying the Australian dollar, completely ignoring the broader panic in the bond market.
But the real story is, Who are these people?
Ah, the cast of characters.
Right. Who are these massive players capable of stopping an entire global currency market dead in its tracks, completely ignoring a screaming bond market, and just soaking up billions of dollars in flow? I really want to know who is on the other side of my trades.
It is vital to understand that it's not just one person. And it's not a single type of participant pulling levers behind a curtain.
It's not a cabal.
No. The market ecosystem is incredibly diverse, and the absorption we see is a complex mix of highly different players. They are all operating with completely different mandates, different risk profiles, and drastically different time horizons.
Okay, let's stop listing them and actually walk through a scenario. Let's trace a massive flow of capital through the ecosystem. Let's say $1 billion enters the market. Who is the first major structural absorber we encounter?
Let's start with the corporates.
Corporates, like regular businesses.
Exactly. Corporate hedging is a massive, relentless source of absorption that most retail traders never even think about.
Never.
Imagine a giant multinational exporter. Let's use a Japanese automaker.
Okay, Toyota, Honda, someone like that.
Right. They manufacture their cars in Nagoya, Japan, paying their factory workers, their utility bills, and their taxes in Japanese yen.
Right, their costs are in yen.
But they ship thousands of those cars to Los Angeles and sell them to American consumers for US dollars.
Okay, so they are constantly piling up mountains of US dollars in their bank accounts, but their actual structural expenses are all in yen.
Precisely. They have a massive currency mismatch. If the dollar crashes against the yen, their profit margins get wiped out.
Because their dollars buy fewer yen to pay their workers.
Exactly. So you have to constantly, relentlessly sell US dollars and buy Japanese yen to hedge their exposure and lock in their profits.
And they just do this constantly.
They do.
Yeah.
And here is the key to corporate absorption. They have to do this regardless of what the technical chart looks like.
They aren't looking at a 15-minute man-ED crossover.
They don't even know what that is.
They don't care.
The corporate treasurer is operating on a 5-year rolling hedging program. They have a strict mandate from their board of directors to hedge 50% of their anticipated dollar revenues every single quarter.
Wow.
They don't care if the dollar is breaking out to a new all-time high. They are going to execute their algorithm to sell those dollars. They provide a relentless, price-agnostic supply. They act as a massive structural absorber of dollar demand.
Let me make sure I'm internalizing the scale of this. We have a corporate hedging desk operating on a 5-year timeline, executing an algorithm that just mechanically sells $100,000 every 5 minutes for a month straight to run their business.
Yes.
And that completely neutralizes the trades of a technical day trader who thinks they've spotted a 5-minute breakout pattern.
That is exactly the reality of the market.
That is wild.
The day trader is fighting a corporate hedging algorithm that doesn't know they exist, doesn't care about their technical indicators, and has capital reserves 1,000,000 times larger.
That is deeply humbling. Okay, so the corporate exporter is our first major character.
Yeah.
They're dumping those dollars. Who is sitting on the other side, absorbing that corporate flow over a massive timeline?
That is where you meet real money investors.
Real money.
These are your massive pension funds, sovereign wealth funds, and giant asset management firms.
The big boys.
Their defining characteristic is their time horizon. It is measured in quarters, years, and sometimes decades, not minutes and hours. Right. They care about long-term asset allocation, yield generation, and demographic liabilities, not short-term price fluctuations.
So if the Norwegian Sovereign Wealth Fund decides they need to increase their structural exposure to U.S. tech stocks or U.S. bonds, they need to buy those U.S. dollars that the Japanese automaker is selling.
Yes. And if their macro analysts decide they need to increase their allocation by just 2%, we are talking about tens of billions of dollars.
Just a tidal wave of money.
And if they decide to execute that, they don't buy it all on a Tuesday morning.
They break the market.
They would. They use the dealers we talked about earlier. They will systematically build that position over weeks or months, buying every single time the price dips.
So they are the floor.
They provide a massive, slow-moving floor of absorption. They are the whale slowly swimming underneath the choppy surface water.
Okay, so we have the corporates hedging their real-world businesses and the real money funds allocating capital for the next decade. That provides the slow, steady hum in the background.
The structural flow.
But what about the entities that can just brute force the market? I'm talking about central banks.
Central banks are a completely different animal because they are perhaps the most powerful absorbers in existence.
Why is that?
Because, unlike every other participant we've discussed, they are not strictly driven by a profit motive.
They aren't trying to make money.
No, they don't have a value at risk limit in the traditional sense because they can literally print the domestic currency they are trading.
Give me a historical example of a central bank acting as the ultimate absorber.
Look at the Bank of Japan in late 2022.
Oh, I remember this.
The US dollar was surging against the Japanese yen. It was breaking out of every historical technical level, largely because US interest rates were rising while Japanese rates stayed at zero.
The divergence was huge.
Exactly. The technical momentum was violently bullish for the dollar. The entire speculative market was buying. But the Bank of Japan decided the currency was depreciating too fast for their domestic economy to handle.
So they stepped in.
They stepped in with massive, unannounced interventions. They sold tens of billions of US dollars from their foreign reserves and bought yen.
Just dropping anvils on the market.
Yes, the market would push the price up to a specific level, say 150 or 151, and suddenly an invisible wall of absorption would appear.
They just wouldn't let it pass.
The Bank of Japan simply swallowed every single speculative buy order and then slammed the price down violently. They were the ultimate absorber, dictating the ceiling of the market through sheer force of capital.
Now I have to challenge that because central banks aren't invincible, right? If they have infinite domestic money, why do currency pegs ever fail?
That's a great question.
Because I'm thinking of George Soros famously breaking the Bank of England in 1992.
Yeah.
Didn't the absorption fail there?
It's a brilliant distinction. Central banks have infinite domestic currency, yes, but their foreign reserves are finite. In 1992, the Bank of England was trying to absorb massive selling of the British pound to maintain its peg in the European exchange rate mechanism. To do that, they had to use their reserves of Deutschmarks and dollars to buy pounds. Soros and other massive leveraged players realized the bank's foreign reserves were running out.
They knew the ammo was low.
Exactly. The aggressive flow simply overwhelmed the central bank's finite capacity to absorb. The dam broke.
Which brings us perfectly to the next group, the leveraged players, the ones who broke the Bank of England.
The speculators.
The hedge funds, the commodity trading advisors, the proprietary trading desks. How do they fit into the absorption puzzle?
They are the absolute wild cards of the ecosystem. Sometimes they act as absorbers.
How so?
For instance, algorithmic mean reversion strategies, bots that are programmed to buy whenever price drops 2 standard deviations below a moving average. They provide temporary liquidity and absorption at the edges of a trading range.
But they don't stay there forever.
No, they are highly sensitive to risk. When a structural trend finally breaks, when the big dam actually cracks, the leverage players instantly switch from being absorbers to being amplifiers.
They pile on.
Exactly. The commodity trading advisors, CTAs, are basically massive automated trend-following funds. When a breakout finally happens and absorption fails, the CTAs pile in aggressively.
They just add fuel to the fire.
They withdraw their passive liquidity and flood the market with aggressive market orders, turning a small crack in the dam into a catastrophic flood.
And we can't talk about the cast of characters without talking about carry trades, right?
Oh, absolutely not.
Because I know yield plays a huge, persistent part in creating this invisible flow.
Carry trades are the gravitational force of the foreign exchange market. Yield-seeking capital creates persistent structural demand that completely alters market mechanics.
Walk me through that.
Let me break down exactly how it works physically. If you are a macro hedge fund and the Japanese yen has an interest rate of 0%, but the Mexican peso has an interest rate of 11%, you don't just buy pesos.
Right.
You borrow billions of Japanese yen at 0%. You immediately sell those yen in the open market and you buy Mexican pesos. You then take those pesos and park them in Mexican government bonds yielding 11%.
And because you are leveraged, that 11% differential can become a massive annual return.
Exactly. The interest rate differential is physically credited to your account every single day during the rollover period.
Every single day.
And this creates a relentless bid because to stay in the trade and collect that daily yield, you have to maintain your long position in the peso and your short position in the yen.
You are getting paid handsomely just to sit there and do nothing. You won't sell unless something drastically changes because you are getting paid to wait.
Precisely. And this creates a massive structural absorption layer. If a technical trader comes in and tries to short the Mexican peso because it looks overbought on a daily chart,
They get crushed.
Their selling pressure is instantly absorbed by the massive wall of carry trade capital that is fundamentally incentivized to hold the asset.
So because all these massive players, the
Hmm.
corporate hedgers on their 5-year plans, the pension funds accumulating over quarters, the central banks defending policy, and the carry traders collecting daily yield because they all operate on such long, conflicting timelines, their actions don't create instant, clean trends on a 5-minute chart.
They don't.
They create long, drawn-out campaigns.
Campaigns is the perfect word. It implies a long-term strategic operation involving logistics, planning, and execution over time, rather than just a quick tactical skirmish.
Right.
Every sustained structural move in the market, every real multi-month trend that makes careers, begins with a campaign of absorption.
It has to, because they can't just click a button and enter a $10 billion position.
They would ruin their own average price.
Exactly. Before a trend is ever visible to the retail public, there has to be a period of quiet, meticulous accumulation or distribution. The big players are carefully building their positions.
Yeah.
I think of it like building a massive modern skyscraper in the middle of a crowded city.
Oh, I like this one.
For months, sometimes even a year, you walk past the construction site and all you see is a messy, chaotic hole in the ground.
Just dirt.
It's just dirt, noise, excavators moving around aimlessly. To the untrained eye, it doesn't look like a building at all.
It looks like a mess.
Right. You don't realize they're spending all that time painstakingly pouring a massive concrete foundation, sinking steel pillars deep into the bedrock. And then, once that foundation is finally set and cured, suddenly the building shoots up 30 stories into the sky in a matter of weeks.
That is exactly how market trends operate. The accumulation phase, the pouring of the foundation, looks entirely like random noise on a price chart.
The messy dirt.
The market appears directionless, choppy, and chaotic. Breakouts fail constantly. Your momentum indicators whip back and forth, completely unreliable because every single time the price pushes out of the range, an absorber pushes it back in to fill their massive order.
They're just pouring concrete.
The market is coiling. It is storing immense kinetic energy.
It's storing energy by trapping traders. The retail day traders keep trying to buy the breakout, and they get stopped out. They try to short the breakdown, and they get stopped out.
Over and over.
They're providing the bricks for the foundation. The big players are just absorbing all of those mistakes, quietly building their massive position at an average price they are happy with.
Yes. And the transition, the moment the skyscraper finally starts shooting up into the sky, happens when absorption finally gives way to pure imbalance.
When the dam completely breaks.
Exactly. It happens for one of two reasons.
Okay, what are they?
Either the dominant player finally finishes building their massive position, turns off their TWAP algorithms, and stops absorbing the counterflow, or the opposing side simply runs out of capital, breaches their risk limits, and can no longer absorb the incoming aggressive flow.
They tap out.
The artificial ceiling or floor is suddenly removed, and the price expands rapidly, searching for a liquidity that is no longer there. That violent expansion is what we call a trend.
And this mechanical process happens on all time frames, right? It's not just on the weekly charts.
It is highly fractal. It happens on the minute charts and it happens on the yearly charts. Intraday, this exact process happens around specific structural events, like options fixing times.
Explain options fixing times briefly for the listener who might only trade spot forex or basic equities and hasn't ventured into derivatives.
Sure, in the institutional market, billions of dollars of currency options expire at specific times of day. For example, the 10 a.m. New York cut.
Okay, 10 a.m.
As that time approaches, the dealers who sold those options have to aggressively hedge their exposure in the underlying spot market.
They have to balance their books.
This creates a massive bottleneck of capital. For the 2 hours leading up to the fix, the market might range tightly as dealers absorb flow to manage their delta risk.
The compression.
Once the clock strikes 10:01 a.m. and the options expire, that hedging mandate vanishes instantly.
The foundation is done.
The absorption disappears, and the market often breaks violently in one direction.
The foundation was poured for 2 hours, and then the building shot up.
Exactly. The core skill of trading is not drawing lines. It is recognizing when the market is in the storing energy phase versus the releasing energy phase.
Let's zoom out for a second, because if these individual corporate hedgers and intraday options dealers are the bricks and mortar of market stability, then macroeconomic policy must be the gravity holding the entire building together.
It absolutely is.
If we look at the longest time horizon possible, the ultimate source of this absorption is macroeconomic, isn't it?
At the highest structural level, absorption is dictated almost entirely by central bank policy and sovereign yield differentials.
The interest rates.
We touched on the mechanics of the carry trade earlier, but we need to understand the gravity it creates. When a country's central bank raises interest rates aggressively to combat inflation, it acts like a giant, irresistible magnet for global capital.
Because money flows where it is treated best.
Exactly.
Higher risk-free interest rates attract global capital because pension funds and investors fundamentally want a higher return on their massive cash piles. It's the most basic law of financial physics.
It is, and this macro flow creates continuous, deeply structural demand for that specific currency. This demand is so powerful, so vast, that it can absorb immense amounts of speculative selling pressure for years.
Decades even.
Yes, this is the bedrock of a macroeconomic carry regime. If you have severe monetary policy divergence, say, the U.S. Federal Reserve is aggressively hiking rates by 75 basis points a meeting, while the European Central Bank is paralyzed and keeping rates at zero.
A tidal wave of capital floods out of Europe and into the United States.
Exactly.
So the interest rates act as a gravitational pull, creating a structural layer of absorption that holds the market in a massive multi-year trend. But what happens when that gravity suddenly turns off?
It gets ugly.
What happens if U.S. inflation suddenly plummets, the economic data rolls over, and the Fed unexpectedly signals they are going to pivot and cut rates drastically? Does that structural absorption just gracefully unwind?
It does not unwind gracefully. It vaporizes.
Vaporizes.
And the results are the most incredibly violent events in financial markets. Because these macroeconomic absorption structures, while incredibly powerful, are actually highly fragile.
Why are they fragile?
They are based entirely on forward-looking expectations. When policy expectations shift abruptly, maybe there's a shock inflation report or a sudden credit event in the banking sector, the entire premise of the carry trade is invalidated.
The math no longer works. The yield differential that justified holding the position disappears.
And instantly, the structural absorption framework breaks down. The big players who are happily absorbing all the selling pressure for 2 years suddenly step away.
They just pull their bids.
They cancel their bids. They realize they are caught offside.
And now they have to exit. The giant whale has to fit through a tiny door.
That is when you see the largest, most violent repositioning moves in foreign exchange.
The flash crashes.
It is not necessarily because a single new piece of data mathematically justified a 500 pip drop in a currency over 3 hours. It is because the existing structural absorption that had been artificially holding the market up utterly failed. What was once a stable, highly liquid market becomes totally catastrophically unstable.
Everyone is rushing the exits.
Everyone, the carry traders, the CTAs, the dealers trying to get through the same narrow exit door at the exact same millisecond.
The dam explodes and the valley floods. And that moment of failure, that violent transition from balanced absorption to pure, unadulterated chaos, is exactly what every market participant needs to be prepared for.
You have to see it coming.
Because if you are just looking at a lagging price chart, you will never see it coming.
Yeah.
You'll just see a chart that looked perfectly healthy yesterday and is in an absolute free fall today.
Which is why we need to redefine our entire approach and strategy to markets.
Yes, let's get into strategy.
We have to accept the reality that absorption does not last forever. Equilibrium is temporary. Failure eventually occurs.
Inevitable.
And when it does, balance violently turns into imbalance. All those retail traders who were trapped trading the chop during the compression phase,
Yeah, what happens to them?
their stop-loss orders are sitting just outside the range. When the dam breaks, those stop-loss orders, which are market orders, are triggered en masse.
They get run over.
This floods the market with aggressive flow exactly when absorption has vanished. Positions are unwound in a blind panic, and price accelerates in a nonlinear way that traditional technical analysis simply cannot predict or contain.
Okay, so we have covered the deep theory. We know why price is a lagging indicator. We know the exact mechanics of what absorption is.
Right.
We know who the massive players doing it are, from corporates to central banks. And we know why it eventually fails catastrophically. How do we actually use this information? Give me the practical framework.
Okay, let's break it down.
If I am sitting down at my trading desk tomorrow morning, booting up my charts, how do I analyze the market through this specific lens?
You need to implement a 4-part practical framework. You must stop asking the amateur question, where is the price going? And start asking 4 specific structural questions about the flow of capital.
Okay, what is question 1?
Question 1, who is likely driving the dominant flow in the market right now?
Context.
You have to understand the context of the day. Is it the last day of the month, meaning massive global pension funds are mechanically rebalancing their portfolios regardless of price?
Right.
Is it a major central bank policy announcement day where macro expectations might shift? Or is it a random Tuesday in August with no news, meaning the market is just being tossed around by algorithmic leveraged funds playing mean reversion games?
You have to know who is in the room with you before you sit down at the poker table.
Yeah.
If the central bank is at the table, you play differently than if you're just playing against day traders.
Precisely. You must contextualize the flow. Question 2. Is price responding proportionally to the volume and flow being injected?
The effort versus result.
This is where you look at your tape, your footprint charts, or your volume delta. If you see massive volume, incredibly heavy buying pressure hitting the ask, but the price is barely ticking up or is even rejecting,
Red flags.
your alarm bells should be deafening, absorption is actively present, someone is soaking up that effort.
The engine is revving, but the parking brake is firmly on. Okay, what's question 3 in the framework?
Question 3. Is the broader market balanced or imbalanced?
Balanced or imbalanced?
Are aggressive directional moves being sustained,
Yeah.
taking out previous highs and holding them? Or are they repeatedly being reversed and pushed aggressively back into the existing range?
If they're returning to the mean.
If every breakout attempt fails and leaves a long wick on the hourly chart, the market is structurally balanced. It is in an absorption phase.
So don't trade the breakout.
Do not try to trade it like a trend. Trade the edges or stay out entirely.
Recognize the regime you are in. Don't bring a surfboard to a calm lake. And the final question.
Question 4 is the most lucrative. Where might that current absorption structurally fail?
Where does the dam break?
What specific conditions would force the massive player to step away and stop absorbing? Is there a major inflation report coming out tomorrow that could invalidate the macro carry trade?
Or options expiry.
Is there a massive options expiry at a specific strike price that will remove the dealer hedging flow? You are actively hunting for the tipping point where balance becomes imbalance.
I love this framework because it's proactive, not reactive. But I have to push back on one deeply ingrained trading mantra, just playing devil's advocate here to make sure we cover all bases.
Conservative, man.
Everything I have ever read, every classic textbook on trading from the 1980s onward, says that high volume is a guarantee of a strong trend. The classic wisdom is volume precedes price.
Yes.
If there is huge volume on a breakout, you must follow the volume. You're telling me that's wrong.
I am telling you that is a common and extremely dangerous retail misconception.
Dangerous.
High volume does not guarantee a trend. In fact, isolated high volume often means incredibly heavy absorption.
Because of the conflict.
Think about the mechanics. For volume to be high, there must be massive participation on both sides of the trade. It means two massive titans are fighting it out. A huge buyer is meeting a huge seller.
They're clashing.
And until one of them exhausts their capital and loses the battle, the price isn't going to go anywhere sustainably.
So a technical breakout accompanied by high volume might actually just be a massive trap.
It frequently is the ultimate trap. Retail traders see the breakout and the volume spike, they pile in with market orders, and they run directly into the brick wall of a corporate hedging desk that is more than happy to absorb all that aggressive retail liquidity at a premium price.
Wow.
The breakout fails, reverses, and the retail traders are left holding the bag. The volume was just the sound of retail accounts getting chopped up by institutional limit orders.
That is brutal. And similarly, people always assume that high volatility means high opportunity. The saying is, volatility is a trader's best friend.
Volatility can be a friend, but it can also just be random noise within a balanced market. It can just be price violently whipping back and forth within a massive absorption range as algorithms hunt for liquidity.
It's just chop.
True, structural opportunity doesn't come from mere volatility. It comes when the market fundamentally shifts from balance to imbalance. Most importantly, and this is the core takeaway for anyone listening, large, slow-moving capital matters infinitely more than fast, visible, hyperactive flow.
The sovereign wealth fund, methodically accumulating over 3 months, matters vastly more than 10,000 day traders panic buying on a 5-minute chart.
Infinitely more. If you want to survive and thrive in these markets, you have to fundamentally shift your strategy. You have to stop trying to predict the direction of the next 5-minute candlestick using lagging mathematical derivatives of price.
Moving averages.
You have to start observing the deep structural, mechanical process of inventory transfer.
This has been an absolute masterclass in market reality. Let's summarize this entire paradigm shift for the listener. We're moving away from the illusion. Price does not lead the market. Capital flow leads the market.
That's right.
Price is just the footprint left in the mud after the battle for capital is already over.
That is the absolute essence of it. Once you stop fighting the surface-level price action and you start aligning your analytical thinking with the underlying mechanics of flow and absorption, the perceived randomness of the market actually fades away.
It stops being a casino.
It stops feeling like a chaotic casino designed to steal your money.
Those chaotic, sudden moves that used to stop you out, ruin your week, and make you think the market was rigged. They become highly structured. They become conditional.
They make sense.
You realize they weren't random at all. They were the inevitable, mechanical result of a massive dam breaking. As you look ahead to your next trading session or your next major macro investment decision, the goal is no longer to chase technical breakouts blindly because a line on a chart crossed another line.
No, you leave that behind.
The goal is to watch patiently, to look for the invisible signs of kinetic energy storing up in the compression, to identify who is doing the absorbing, and to be positioned and ready for the exact moment that massive energy is finally released.
It requires immense patience to observe rather than react, but it provides ultimate clarity. You are no longer guessing at directions. You are observing a mechanical process of risk and inventory transfer.
I want to leave you with one final thought, something to really mull over the next time you open up your charts and stare at the flashing numbers. The next time you look at a market and you see the price sitting perfectly still despite a chaotic news cycle and surging volume, do not ask yourself why the price is moving. Ask yourself the much more dangerous, much more revealing question. What massive, invisible forces are actively working to keep the price exactly where it is?